Hello guys, this is David, the spread doctor, and this is my journal for Friday, the 16th of October. It was another mixed bag in the equity markets today, and as you can see from the heat map, the healthcare sector is about the only sector that clearly has more green than red. So this is the health sector right here. Where am I? The healthcare sector is the only sector that has pretty much more green than red. All the other sectors are mixed, and that is clearly what happened in the markets today. And at the closing bell, the Dow was up about 100 and something points, the Nasdaq was down, the S&P 500 was flat, and the Russell 2000 was down. But if you take one step back and look into the market internals, the market breadth shows a slightly more bullish picture than the heat map or the index close suggest. The ratio of advancing to declining stocks was 5-3. So for every 3 stocks that closed lower, 5 closed higher. And the market was actually higher than where it closed, and that's because there was some good economic data that came out today. The US retail sales ticked up by about 1.9% versus 0.8% that was expected by the street. And the consumer sentiment for September also ticked up. But the lack of good news or the lack of progress being made on the stimulus package kind of overshadowed all the good retail numbers and the consumer sentiment, and the markets ended up being a mixed picture. And that takes me on to the VIX. So the VIX was up today. It was up by about 1.6% to close at 27.41. The level of uncertainty being baked into the market is still high, but with the earnings season ticking off, it has put a damper on things in terms of the number of underliers with high IV. So the number of stocks I'm finding that have high implied volatility and without earnings in the November expiry cycle has dwindled to a trickle. I'm only finding a handful. That said, I had no new trade ideas today or indeed the whole week. The October contract expired today, and there are now 35 days until the November contract expires. So next week I'm going to get kind of aggressive. I'm going to aggressively look for spreads to sell in the November contract, but I'm not going to be reckless. So my selection criteria still has to be met, and I'm not going to compromise on that just for the sake of opening positions in the November contract. In other news, here is something quite interesting that caught my eye this week, and it took me back to my university days, and it is the velocity of money, or M2 as it is known in the economic jargon. The velocity of money, or M2, is at an all-time low going back to 1960. Going back to 1960 when it was 1.8, and look at 2020, it's around 1 point, let's give it 1.1. I mean, you can see it's just falling off a cliff here. And it's the low velocity of money is kind of emblematic of the problems with the Main Street economy in comparison to Wall Street. So what is the velocity of money? Velocity of money is simply the frequency at which one unit of a currency is used to buy goods and services domestically within a given period, which is usually a year. So in other words, it is the number of times a dollar changes hands. So I use my dollar to buy a bottle of water. The shop owner I bought the bottle of water from uses the dollar to pay his rent. The landlord uses the dollar to buy paint for improvement on the property, etc., etc. And that's how the velocity of money accelerates. The money just keeps on changing hands. And although the use of physical dollar bills is significantly lower than it was in the 1960s, the M2, or velocity of money, still captures cards and electronic payment mechanisms. So it's got nothing to do with people using physical cash bill or dollar bills less than they used to. So why is this important, you ask me? Well, it is important because it's an indication that the economy is not really growing or not really, rolling along. And if you take into consideration that the Federal Reserve has printed trillions of dollars since March, and this was to encourage lending and stimulate the economy. But the money is not finding its way to those who will spend it. Instead, the money is going to the likes of hedge fund managers, Wall Street banks, and other financiers who do not spend the money, but they hoard it in properties, in art, in yachts, in diamonds, etc. So the money largely goes to those who already have loads of money, and they find it difficult to spend the money on everyday items that would accelerate the velocity of money. So the money ends up circulating in a small circle, and it reduces the velocity of money. The money just doesn't change hands quickly enough. And if you think about it, I mean, how many washing machines, how many kettles, how many shoes, how many shirts, how many toasters can Jeff Bezos or Lloyd Blankfein, former Goldman Sachs CEO, how many can they buy in a year? Now, if one was to take 10% of the money that Jeff Bezos made just between March and October this year, and you distributed that money to 10,000 people on low income, there would be a lot more economic activity generated, and the velocity of money would accelerate. I mean, these guys would go out and buy more washing machines, more kettles, more shoes, more shirts than Jeff Bezos can buy. It's just simple logic. So that's that. I mean, that's why the velocity of money is kind of important, but the media don't talk about it that much. But to finish off, I might come across as advocating socialism. I am a capitalist at heart. I'm the biggest capitalist you ever come across. And I'm simply just using this example to illustrate why the velocity of money is so low. I'm by no means advocating taking money from the rich and giving it to the poor. That's not how capitalism works. But in order for economic activity to grow, the Fed and the government have got to find a way to get this velocity of money to go back to around here, at least, right? I mean, look at where it is down here. So the money's just being parked and it's not generating enough economic activity. Moving on to open positions. Actually, I mean moving on to positions. I have not a single open position. All my October positions have closed, and the October contract expired today. So the one position that was open was this Facebook synthetic position. Facebook closed today. I believe it closed around no point guessing, let me check it. So Facebook closed at 265, and the position was 275, 270 put. This means if the position was still open as at today, both legs would have expired in the money. The 275 put would have been assigned and the 270 put would have been automatically exercised. In other words, the full defined risk on this spread would have been realized. That said, Facebook or FB, it did go above 275 earlier in the week. I think on Monday it went up on high volume, but the market makers failed to mark down the spread to the suggested target price of 52 cents. And since then, Facebook has traded lower on much lighter volume, so time has run out for this position. Now, there was an opportunity to close out the position with a small loss or even a break even or a small profit. And because this is a hypothetical position for me, I cannot definitely say what I would have done. And I hate fitting the curve. And I always criticize traders who try to fit the curve, pull up a chart and point to the low point on the chart and say, oh, I would have bought here and sold here. It's so easy to say, right? But it's all hypothetical. The emotional side of it is missing. So I don't do fit in the curve. I did not hold this position. But if I did, I may well have closed it out at break even on Monday after seeing the large volume. Or I might have taken the view that the large volume means that buyers are now in charge and I'm going to hold on to it, and I would have held on to it into today. But the bottom line is this. What I would have done or what I would not have done is clearly speculative and irrelevant at this point. But let us assume that I did hold the position into today and I took the full defined risk in the position. My line of thinking would be something like this. I've had 3 positions this month in BABA, SE, and PDD. All 3 of them hit my profit targets, and I made money on all of them. I've applied the recommended position sizing, and the size of the Facebook position is not larger than any of the 3 other positions, and overall I made money for the October contract. I might have made a tiny bit of money because of the loss on Facebook, but of course the losses from Facebook reduced my overall profits, but overall I did not lose money. I did not lose money in a month when the broad index, the S&P 500, was down. In my books, that is a good month. So for me, I'll wipe the slate clean and get ready for the next month. So that's how that would be my line of reasoning if I did take that position. But fortunately for me, or maybe unfortunately, who knows, I didn't get a fill, so that's why I remained a synthetic position. And that takes me onto my watch list. I've only got 3 items on my watch list today: ARKK, CVAC, and TAN. All 3 of them have high implied volatility, and they've got no earnings announcements over the November expiry cycle. And that brings me to the end of my journal for today. I hope you enjoyed listening to my journal. You can leave me any questions or comments below. And have a fantastic weekend. Goodbye.